Chart patterns are a crucial component of trading. Each chart pattern offers a unique outlook on the potential price movements. Today we will discuss one high probability continuation formations known as flag pattern. And by the end of this video you will know exactly how to spot the pattern accurately and be able to trade in confidently and profitably. The flag pattern is one of the best known continuation formation in the trading, which typically appears as a minor consolidation between impulsive legs of the trend. When this pattern forms on the chart, there is high likelihood that the price actions will break the directions of the uh, prevailing trend. The flag pattern consists of two parts: a flagpole and the flag. Let's take a close look to each of these two components. The first component of the flag chart patterns is the flagpole. That represents a trend impulses on the chart after creating a pole. A valid flag patterns will then begin to trade within the side range. Talking on the shape of flag. The flag consists of price actions with evenly distributed tops and bottoms at the same time. This price actions has a corrective character on the graphs. In this manner, it is angled contrary to the trend impulse creating the pole. There are two types of flag chart patterns based on their structures and potential: a bearish flag and a bullish flag. Each of these is absolutely opposite of each other. The bearish flag pattern forms during a bearish trend. The figure starts with the bearish trend impulses and turns into corrections which is directed upwards during the correction phase. The tops and the bottoms are eventually distributed, creating a pulled channel. The confirmations of the bear flag setup comes when the price actions breaks a flag channel's boundary downwards. When the breakout occurs, we have the opportunity to short the asset. The bull flag patterns is the opposite of the bear flag patterns in appearance. First, it forms during bearish trend. The pattern begins with the bearish trend move, which then pauses and turns into the minor bearish corrections. The tops and the bottom of its corrections are parallel as well. The confirmations of bearish flag pattern happens with the upside breakout, and we would prepare for the long positions. The flag pattern has continuations potential on the chart. A valid flag pattern is likely to push at the price actions for the future in the direction of the flagpole. The trend impulses. In addition to this, when you spot a flag formations on your price chart, you can measure an approximate price target of the formations. There are two targets related to the flag formations. The first target of confirmed flag pattern can be delivered using the measure move techniques. The measure move targets is the distance equal to the size of the flag. To measure the size of the flags, you would just take the vertical distance between the upper and the lower channel within the flag. Then you would apply this distance starting from the breakout point. Your first target is located at the end of the distance. Target 2 size of the pole. The next target, the flag formations equals the size of flagpole. So to get this target, you need to measure the vertical distance between the high and the low of the pole. Once you get that distance, you will need to apply it to the pattern. Again, as we did with target 1, you would apply it starting from the breakout point. Now that we discussed some of the characteristics of the bull and the bear flag, let's create a concept trading strategy around this setup. At first, I want to add two exponential moving average to help us identify the upper or a downtrend easily. In this case, I added the 21 and 55 EMA, but you can choose any lengths you prefer. When the 21 EMA is above the 55 EMA, we consider the market to be in the uptrend. So we only wanted to start looking for the bull flag pattern when the 21 EMA has crossed above the 55 EMA. If the 21 EMA is below the 55 EMA, we will look for bear flag patterns. Why this filter? Because when the market is trading above the 21 EMA, for example, it means there is a strong momentum to the upside, and any bull flag patterns that are formed above the 21 EMA have a higher chance of succeeding. To enter flag patterns trade, you should first obtain the confirmation signals. The confirmations of the flag comes with the breakout. If you have bullish flag, you will buy when the price actions close a candle above the upper side. If you have the bearish flag, then you would sell the asset when you see the candle closing below the lower level of patterns. One basic rule should be considered when determining the proper stop loss placements. If the price breach the opposite side of the breakout, then you should immediately exit trade because the pattern is most likely false. The most logical location to place the stop loss would be beyond the most expanded slide with this flag structure. So if you were trading a bullish flag, then your stop should be placed below the lowest bottom in the flag. The take profit for the flag patterns should be addressed using the two targets we discussed earlier. It is up to you which target you are going to purchase. However, I would suggest taking profits at each target level to reduce risk and book profits. To enter into a trade using the flag pattern, I also prefer to look for a candlestick pattern that forms on the dynamic area offered by the two EMAs, namely the engulfing candles and the pin bar. These two candlesticks patterns are the trigger for us to get into the trade. If you trade a bullish flag, for example, and you have the bullish candlesticks that forms at 21 EMA, I suggest that the EMA has held up as a dynamic support level. At the same time, the bullish candlesticks patterns suggest that the market has a good chance of going up after its formation. Basically, you want confluence of these elements to give you a high probability of the trade working out. So how you enter into the trade once these candlesticks patterns appear? There are two main entries. The first one was to wait for the breakout, which is a more conservative way to trade. The second entry method is a more aggressive entry because you do not wait for the confirmations of the move and take the trade before the breakout at the close of the candlesticks patterns inside the flag patterns, or at the break of the high or low of candlesticks. By confirmation, it means to wait for another event to happen to give you a better indication so that the market will be going up. For example, if you trade a bull flag, this means you don't wait for the breakout to happen. With this entry, you will have a higher risk to reward ratio for the same take profit levels, but the trade-off is that you will get stopped out more often. The ideal scenario would be a pin bar or engulfing candles that forms right when the price breaks the flags, but this is the rare setup. I prefer to have the confluence of factors, namely the price rejected the dynamic area, formed the two EMAs, the formations of candlesticks patterns, and the flag breakout. With any trading setups, the more signals you have supporting the directions of your trade, the higher the chance of your trade working out. There are several examples of the valid trade. If you trade stocks, many traders use volume as the added confluence of the trade signals. What you want to look out for this for increase in volume when the market starts moving up from the bull flag pattern. For example, here you can see the volume has increased when the market broke out from the bull flag pattern. This sounds that there are buyers coming in push the market up, and this gives target an added value that the bull flag pattern has a higher chance of working out. As a side note, in the Forex market you can't use volume because there's no centralized exchange. This means the volume you see in the Forex market is not an actual representation of the total volume in the market. You can also increase the flags pattern's probability with divergence. A divergence is when the market is moving at different directions than your indicator. There are a few indicators that can identify divergence, but what I like to use in this stochastic oscillator to identify a divergence on the bull flag pattern, for example, what we are looking for this the market to be forming a higher low, but the stochastic oscillator to form a lower low. This is called a higher divergence. Also remember the previous confluences element we discussed before those. At the point where the candlestick pattern is formed, we want stochastic oscillator to form a lower low. Here's an example. We have higher divergence as the market is making the higher low, but the stochastic oscillator is making a lower low. The setup even more powerful. It is contains candlesticks formations for if the price rejects the dynamic area formed by the two EMAs. So whatever you are looking for an entry, you want to see that there is a higher divergence to give you added confidence that the flag patterns will work out. Here you can see that the market is clearly in the downtrend. The 21 EMA is below the 55 EMA and the market is forming lower lows and lower highs. The market went down and formed the bear flagpole in the few bars. After that, the market started consolidating and moved sideways. If you notice, the bars are relatively smaller as well. This is a sign that the market is preparing for a possible downtrend move. Just as the price entered the dynamic resistance area, it formed a bearish engulfing candles. At this point, you can see that the stochastic oscillator is indicating a hidden divergence. So this is the valid trade signal. The market will give you many opportunities to trade this setup. However, you don't want to make the mistakes of trading every single one of them. You will be tempted to trade it every time it shows up, but if you see a flag pattern that doesn't fulfill out confluence setup, give it a miss. Be patient and wait for the next opportunity. If you got any value from this and learned something new, leave us a like, show your support, subscribe to our channel and click the bell icon to stay notified in touch when we upload next video. Until next time.